Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
But you can see on that day that the bulls were still in control. The next day, it opened a little bit lower, but again, the bulls held control throughout the day, but you can see it didn't quite close as strong towards the end of the day because it did not close at the high point. But it closed higher to the high point, and it made a new high at the close of that day. Again, moving into the riskiest period, buyers still in control. Next day, same pattern, but you can see that the buyers gave up a little bit. In fact, there was one point we opened, and there was one point that actually during that candle, that third candle over, it had actually gone down a little bit. That tells you maybe the buyers are slipping a little bit. None of those three candles would tell me to run for cover or run for cash. They're all bullish candles. But that engulfing pattern on the fourth day, in which we engulf the entire previous day's upward push, tells me that either the control is beginning to slip or it has slipped. Now, if I just came off of 3 big bull days like this, I would look at this as nothing but a profit-taking day is how I would look at that. But even though I look at it as profit-taking, I'm not going to shrug it off. I'm going to take particularly pay more attention to the volume as confirmation or how it opens the next day, because that kind of a red engulfing pattern in which it opens at the high point and closes at the low point is telling me there may be a pivot point occurring. There's a pretty big change here between who's controlled the previous 3 days, or 3 candles I should say, and who's controlling this candle. Not that I can predict the future, but I can prepare for it by possibly and probably bringing a stop order up tighter. So Rick, just looking at that, I don't know about you, but what I would do in this case, if this is how the period closed, I would bring a stop order up at the bare minimum to the low point on the second green candle. If I was a little bit more risk adverse, I would bring my stop order up to the low point on the third candle. And this is the idea of you want to ride the bull trend until the bull bucks you off. And often a bearish engulfing pattern like this is an early warning that, you know what, there could be some bears getting more aggressive and the bulls may be losing their control here. So volume is often the way that we will go ahead and confirm this and decide, is this bearish engulfing pattern strong enough that I'm simply going to take my profit? Or am I going to go ahead and just tighten the stop order and be more reactive and see if this is going to hold through to more of a reversal the next day?
Absolutely.
All right, Rick.
Yeah, good stuff. Good stuff.
You coming in?
I'm keeping an eye on. We're getting some of the questions are things such as are we going to get slides and some information. We're going to give you some follow-up information as we get toward the end, but please keep the questions coming, and you also might have some more questions as we look at the charts. One of the other things I wanted to point out, as with any of these reversal patterns, the bearish or bullish engulfing patterns, some of the things like what's called hanging man, shooting star, hammers, and so forth. Now, some of you may be familiar with them. That may be foreign terminology to others of you. But when you're looking at a reversal pattern, make sure that you confirm it against support and resistance. If it's a reversal at the top, it should occur at a resistance point. If it's a reversal at the bottom, it should occur at a support point. The evening star, I'm kind of fascinated with my own inadvertent graphics here. I'm just kind of, I'm watching the pretty colors come on board here. I'll have to go back and make sure that this animated graphics is taken off next time. Another pattern, and these, by the way, these are just representative patterns, but we're throwing them in here because there are some key patterns that you want to take a look at. This one's called an evening star, and I'm going to move fairly quickly past this because I want to get into some technical indicators too. But again, in this one, this is a multi-candle pattern where you have a candle that starts off showing the buyers are in control, and then what I was referring to a moment ago, an indecision candle. This is the spinning top. And then that is followed by confirmation, which is the sellers in control. So you go from buyers in control to indecision to sellers in control. Now, the reason I wanted to point this one out is because it makes sense with the story. In other words, this is not just a pattern that somebody came up with to sell a book on candlestick patterns. Your sanity check on what you use in analyzing the markets should be able to answer the question, does it make sense? In other words, is there a purpose behind it? Does it help to validate, or does it invalidate the story? And the story here is simply buyers are in control. The window of opportunity is opened up vis-a-vis the indecision. And instead of the buyers regaining control, the sellers come in and take control. And so that is why this is considered, in this case, an evening star, this is considered an uptrend reversal pattern where the shift has occurred between the buyers and the sellers. Now, what I want to do with this is really encourage you to come up with your own toolbox of patterns that work for you. As I mentioned, there are literally scores of patterns out there, but I wouldn't recommend that you use scores of patterns. It's very difficult, for one thing, when you're looking at charts, to run through in your brain 50 different patterns. I'll tell you, we tend to focus in on about half a dozen, maybe 5 to 10 patterns constitute the lion's share of what we look for in our analysis. So we're not using, you don't have to learn scores and scores of patterns. It's not necessary. Find a handful, apply them consistently, and most important, manage risk for when you are wrong. Not if you're wrong, when you're wrong. There are going to be times when you're just going to miss the boat. When that happens, you're, in spite of your best analysis, when that happens, you need to make sure that you don't take a catastrophic loss. That's the risk management part. We've got entire presentations focused on the discipline of risk management. There are entire books written about that. Some excellent books out there. If you want a recommendation on reading material for risk management, let me throw out one that I think is one of my favorites that I've read recently by a fellow by the name of Peter Bernstein. Some of you may have read this. It's called Against the Gods, The Remarkable Story of Risk, published by Wiley. Excellent book. It's not a how-to book as much as it is a why book. And when it comes to risk management, you realize that managing risk is more of an emotional and psychological exercise than knowing how you manage risk and why you need to do that is extremely important. So again, if you want that, it's Against the Gods, The Remarkable Story of Risk, Peter Bernstein, published by Wiley. Now, in a lot of our analysis, we're going to be looking at moving averages. So here's what we're going to do next. I'm going to take a few minutes and talk about moving averages, not because they are the end-all, be-all of technical indicators, but because they are kind of the bread and butter for us. Again, there's going to be a lot of people that are going to use other things, so don't. I'm not saying that this is superior, but it's what we use, and we find from our experience that it is a very good job. After going through this, then we're going to shift into the charts, and we're going to start breaking some of the currency pairs down and taking a look at just where we are right now at this point in time, seeing what the momentum and the direction looks like. But moving averages, why do we use moving averages? Why are we such big fans of moving averages? Well, one of the reasons why is they're intuitively appealing. They just make a lot of sense. They tend to be a little easier to relate to price. Of course, price and volume being our first line of defense in technical analysis. And the moving average just tends to relate very well to price. Now, something you want to keep in mind about any moving average is that it is a trend-following indicator. What do I mean by that? Well, there's basically 3 ways that any market can go: up, down, or sideways. And by the way, that's going to be dependent upon the time frame that you're looking at. If you shift time horizons from an intraday chart, say some of you might be day traders, and so you're just looking at a 5-minute chart. Others of you might be shorter-term swing traders. Maybe you're looking at a 100-day daily chart, and some of you might be longer-term position traders or longer-term investors, and so you're looking at a weekly chart. Well, the trend very often will vary depending on the time horizon that you're looking at. So once you've selected your time horizon, you have to look to see if it's trending up or down. Now, moving averages work for uptrends and they work for downtrends. They don't do a very good job when the stock is moving sideways, or in the case of what we're looking at here, when the currency pair is moving sideways.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.